Hey everyone, and welcome into episode 46 of Great Quarter Guys. I'm your host and research analyst here at FreightWaves, Andrew Cox. I have with me Seth Holm, the senior research analyst on our Freight Intel team here. He is a consumer and retail guru. We're going to talk a little bit about, we're going to do our fun see or no section, you care or not. We're going to run through a few of those. Then we're going to get into the holiday season, our expectations for the shopping holiday season. And we're going to get into the big discussion today is on driver wage inflation. We just heard news last week that, or maybe the week before, that Schneider National was raising driver wages up 4 cents a mile for experienced drivers, 2 cents a mile for inexperienced drivers. What does that mean for the market? Do we think that the rest of the market is going to follow suit and raise wages as well? But let's bring Seth in here. How are we, Seth? Good to have you, man.
Good to be back. Thanks, Andrew.
Yeah, brother. So this is episode number 46. There is only one number 46 in the Professional Football Hall of Fame. That is Lou Groza. He had a very interesting career, if you didn't know. He was an offensive tackle from 1946 to 1959, and then he had a back injury that did not allow him to play offense anymore, and then he became a kicker, and he has like 1,600 points in the NFL, incredible career, made it as both a tackle and a kicker. So let's jump in it. Kevin's on vacay. Seth is here with me. Let's jump into our ode to see or no. This is our gauntlet of interest called You Care or Nah. The way this works, I'll give you an event, I'll give you a topic, I'll give you a something going on, and you tell me whether you care or nah and why. Number one, the National Retail Federation published its Consumer Holiday Spending Survey this week. Shoppers say that they plan to spend less overall and pull back on purchases for themselves. In fact, nearly all of the decline in spending expectations this year come from people who say they are hesitant to buy items for themselves, even if there's a big sale. Seth, you care or no?
I care, and I thought this was interesting. I mean, so one thing I learned is being a consumer analyst over the years, a good consumer analyst, you have to put yourselves in the shoes of other people. So you can't just think, hey, what would I buy? It's what does the typical American consumer do. So I think that a lot of, particularly females probably, when they go out shopping, buy things for themselves when they're Christmas shopping. So what was, I found it a little bit surprising that it was going to be down year on year, as we've talked about for the last few weeks. I think it will still be up year over year, as we can get into later. But as you said, what was really interesting was that, the only part of the decline, the gift spending is actually only $8 less on like $1,000. All the decline is coming from people buying gifts for themselves. And so I think that's one thing that's kind of hard to survey and gauge accurately because it's such an impulse buy that in the moment you might end up, especially when you're thinking, hey, I hadn't been on vacation this year. I've been keeping things tight. I deserve this,
Precisely, yeah. That's the reason that I don't care about this is just everything that I buy for myself is always impulse. I never go to the store expecting to buy anything for myself. So I think that people will see some sales, and I think they'll walk back that talk of not buying things for themselves.
And, the other interesting thing is being an analyst in this space. So I looked back at the last time on the graph. This is an annual survey, and they've done it for the last 10 years. The last time that spending intentions were negative for the holiday season were 2015 on that graph. So I went back and I looked at Q4 2015. What did holiday sales actually do? And they were up 3%. So
there you have it.
Also a little bit tough to gauge, whether there's follow through on the survey results.
Certainly so. Something else that's tough to gauge is this valuation of SpaceX. So we heard back in July that Morgan Stanley had valued the company at $52 billion, which is, this is a private company. We don't get a lot of insight into SpaceX. We know that they're shooting up rockets pretty often, putting satellites into space. But they recently, just this week, got a big-time valuation boost from Morgan Stanley up to $100 billion. There's definitely some incentive there for Morgan Stanley. But Seth, do you care or not about the SpaceX valuation?
I care. You and I both are interested in this space. I mean, it's more of a passion for me that I'm just sort of interested in how all this is going to play out. I'm always a little bit nervous whenever you see valuations for public or private companies double in the space of a couple months, especially because generally what that tells you is it's likely to be mainly valuation expansion. As this article talks about, and we were talking about offset before the show, the brunt of the value here is going to come from this Starlink satellite internet business. And that, I would say, I've done very limited research, but it's hard to make any sort of definite prognostications about that business, especially 10, 20 years in the future.
Yeah, you're right. That business is definitely the bulk of the growth here. They Morgan Stanley valued that at $42 billion, I think, or doubled it now to 80.
80 or 90 of the 100 billion came from Starlink.
Right. So it was $42 billion. I think it's now $81 billion or something like that. So they're expecting, and if anybody that hasn't heard of Starlink, it is a network of satellites that SpaceX is currently putting out in space, and they're looking to cover up the entire world and provide broadband internet to every corner of the planet. That's the idea. They think it could be a massive business moving forward, billions of dollars in income and profit every year. But the big caveat here is that it comes with nearly a $250 billion expense to get these satellites up. They're expecting like 40,000 satellites to be in the sky. So it's going to take a lot of money, a lot of reusable rockets to get this up and running. Yeah. All right, so number 3, a little fun one here. This is going to be the first year in 158 years that there will be no live Santa Claus at Macy's. Seth, you care or not?
I care. I've got 2 girls under 3. You have to care. And it's a little sad, honestly. When I read that, a little piece of me died, I guess.
It's a little depressing.
And, I was also surprised. I mean, I think Macy's started in New York City, right, where they have the New York City parade. I mean, so 158 years is a long time. Going back to, 1870 or something?
Yeah.
That people have been sitting in Santa's lap. And I had to think through, when was the camera actually invented?
So I think it was the late 19th century, so 1880s. So you probably just went pre-camera, or just as the camera was becoming a thing.
Right. So I mean, it's a big deal for little kids. It's a little bit sad, and I do think that it will hurt the malls because that drives a lot of traffic to the malls in the holiday season. Yeah,
somebody might make an impulse buy while they're there on Santa's lap. You get them in the store. You want them in the building.
In Atlanta, Lenox and Phipps Mall, a lot of people go, and you have to make your reservation. No joke. 6 months in advance.
Jeez. Okay. I don't care about this one that much. I don't have two 2-year-olds or two young girls at home, so I wouldn't be making a trip to see Santa anyway. I wouldn't be going to Macy's either, so I don't really care too much about this one. But I do feel I've got 8 nieces and nephews now, so they're definitely not going to be happy with this news, all under the age of 12. So they're not going to be happy about no Santa. But number 4 I've got for you is a little rumor here that Dunkin' Donuts may be going private. The management actually confirmed that there was a rumor going around, and they are in talks to sell to Inspire Brands, who is a subsidiary of Roark Capital there in Atlanta. Inspire Brands also owns Arby's and Jimmy John's. The deal is valued at just under $9 billion, which is a 20% premium over the closing price of Dunkin' stock on Friday. Seth, you care or not about Dunkin' going private?
I care, so you're hitting on some good ones for me today. A lot of these are consumer-oriented.
That's right.
So, I moved up here from Atlanta, for those who don't know, to Chattanooga, and so I'm familiar with Roark Capital. They are a very, very, probably one of the most elite restaurant private equity groups in the world, if not the country, and they've been very, very successful. And as for Dunkin' as a business, I actually pitched this as a long to the fund that I worked at many years ago. So I've followed this one. Dunkin' has been a story. It's very, very popular in Boston in the Northeast. And the whole growth story was kind of transitioning west of the Mississippi River and doing that sort of unit growth story. And over the last couple of years, that's kind of slowed. But at its core, Dunkin' is still a really great business. If you think about coffee, it's extremely high margin. Mm-hmm. They're selling you a cup of coffee for $2.50. It probably costs 10 cents.
Yep.
And it's recurring, and it's addictive.
Yeah.
And then, you layer on the fact that they sell donuts and other things in there. It's a good business, and it's not going anywhere.
Yeah, I do care about this one as well. Not so much from the idea of it going private, but I just like Dunkin' as a brand. I think they've been doing great things recently. So they just made, I don't even know who this girl is, but there's a TikTok star named Charlie D'Amello, I think. She's got 100 million TikTok followers. They noticed that she was just posting about Dunkin' Donuts weekly, that she likes Dunkin' Donuts. So they did a deal with her. They made a Charlie drink. I don't even know what the drink was, but they sold hundreds of thousands of them in the first week. They saw a 60% jump in app downloads from that partnership. So not only were people coming in, but they were also downloading the app and purchasing through there, which is exactly what they want. And they've also seen, I think they've been really smart about growth in products over the past few months. They've added a bunch of fruit drinks and tea drinks that Starbucks has had for a while. So they're playing catch up, but I think it's a good brand, and I'm happy to hear that they're going to get what looks like to be a big premium on their valuation. All right, so we got 2 more for you. The last one here is, again, we have some more SPAC news. They cannot keep the word out of my mouth. I try, but it's so hard. SoftBank's making the news this time. They have plans to do their own SPAC, and they say it's crazy how quickly SPACs can happen. So they say within the next 2 weeks, they're going to raise a currently undisclosed amount for a SPAC within the next 2 weeks. Seth, You care or no about this one?
SoftBank, I've followed this company really closely for 10 years. Masayoshi Son, the founder, is, he's really out there. He's a visionary. He is highly polarizing. His critics say he throws them around money like it's candy, and you've probably seen that with WeWork.
Yep.
I think anyone who, there's a lot of private capital in the transportation and the freight tech industry, so I do care from that. It's going to affect valuations, capital structures and deals all across the board in private equity. So from that perspective, I do care. Honestly, I haven't dug into that article too much, so you'd have to tell me a little bit more about it. But SoftBank is a whale in the venture community. I mean, the Vision Fund was, $100 billion?
$100 billion, yeah.
And that was more than the entire rest of the entire VC industry. So I think you kind of have to care whether or not you want to or not.
Yeah, you got to watch out for SoftBank. They are certainly a whale. I'm glad you mentioned that word. Back to the news. They've yet to comment on whether they were that NASDAQ whale that bought up all of the crazy call options, but we kind of know they were. Last one for you. Lowe's. This is actually a crazy story to me because they've really threaded a needle here with their expansion of merchandise offerings. So they've brought in their merchandise offerings this year to include exercise equipment, bamboo bedding, air fryers, movie projectors, and battery-powered scooters. So they're expanding outside of just home improvement. Seth, you're a retail guy. You care or not about this one?
Yeah, I care. I find, without doing much research, I find what they're adding here interesting. I get the exercise equipment, the movie projecters.
What about bamboo bedding?
Too,
that wouldn't make sense, huh?
Right, bamboo bedding. I don't know anything about.
I
There
don't
must
even
be
know what
some
that
new
means.
healthy way of doing things. But air fryers, I think, are selling. A lot of these make sense, right? But I think anything that can drive traffic that is not going to hurt your brand, and if you have excess square footage for it and that sort of thing, and you have it fits your customer base, then
right.
any opportunity to grow comparable store sales, I applaud it. As we talked about, I think they got a little bit lucky. Maybe you said they did this at the end of the year last year.
Yeah, so right, if you're ordering these things from China or from another country that's producing them, you're going to have to order them months and months in advance. They likely ordered these items in Q1 just as the coronavirus was hitting or before it even hit at all. So if they knew that people were going to start buying exercise bikes, then more power to them. But I would think that they got a little bit lucky with these guessing games of what were going to be in demand, and they've really just again thread the needle. And I think you're right. I think they've done a lot of good things. They've added merchandise in areas that people would have already bought. It's with their customer base, their air fryers and electric bikes and scooters and things. It's already with people that are going to build a deck on their backyard or redo their floors.
Right. Yeah. And, I think we talked about on our Slack channel for our research group, Peloton, actually, Goldman Sachs put out a research note last week that they may actually miss the fourth quarter because of the delays at the Los Angeles port. So I think that tells you that demand for exercise bikes is off the chart. And then if you look at Nautilus, which is a company a lot of people have forgotten about, that stock, I believe, is going from about $1 to $25.
Yeah, everybody's talked about Peloton and their growth, but I saw somebody the other day just like ringing the alarm bells. It was like, why doesn't anybody forget about the company that had the 10-year lead? And it's been Nautilus, they had gotten crushed because Peloton had come and taken their market share, but now you're seeing they're reaping the benefits selling more
people
bikes.
Had forgotten about them, and then Nautilus, their market cap's only $1 billion, and so they're kind of the number 2 player. Even Peloton, I think, is a lot more than that. I don't know what it is off the top of my head. I'm guessing 40 or 50 billion.
Yeah.
Yeah.
All right, so let's shift gears here to the holiday season. So we've got this report out from Jay Soul. He is an analyst at UBS, and he's kind of expecting the holiday season to not be as warm as you and I are and as many in the trucking industry are. He's kind of expecting this holiday season head fake. So I'll give you some of these numbers here. He has recently put out the report that he thinks holiday sales will fall 10 to 12% year over year, but these are for soft line goods. So we're talking accessories and clothing type deals rather than hard line goods like electronics and things that last.
TVs, appliances.
Right. Exactly. So this call comes in part from a survey of U.S. shopper intentions. This year, 41% of the respondents say that the economy will affect their holiday spending versus 28% last year. That's the biggest change since the global financial crisis more than a decade ago. And this is there's also a sharp increase in the number of shoppers that will start their holiday shopping by November 1st. I think this is where he's getting that real head fake idea from. He thinks there's going to be a huge pull forward, thinks there's going to be strong holidays for the Cyber Monday, Black Friday deals, but he thinks things will taper off for these soft line goods moving after that. We're definitely going to hold him to the fire on that because we've got this Bank of America data on a weekly basis that we'll be able to see these real-time indicators. But what do you make about this call? Do you think that it has any legs to it?
So I'd say a couple things. I think that the pull forward is a really interesting thing to note from a transportation perspective. So you've seen Prime Day used to be in July. It's in October now. A lot of basically to smooth out. The supply chain's really tight right now.
Yep.
So to smooth out that demand, and you're not going to necessarily have your physical stores open on Black Friday, or you're not going to have the traditional people lining up in tents for 3 miles outside the Best Buy. And so I think that's a really interesting angle and story for trucking, because if he's right about that, then that's obviously negative for trucking, because one of the key questions right now in the trucking market is, is this strong consumer demand going to sustain all the way through the fourth quarter into contract renegotiations in 2021? So that will be interesting. The other thing I'd say is, it's kind of, I've been pretty sanguine on my outlook. I'm not as close to this as I used to be. I used to live and breathe this stuff every day, but the U.S. consumer on all the stuff we follow looks pretty good. So this did catch my eye in terms of, there's not a lot of people out there with any sort of, this is on the more bearish side.
Yep.
So anytime I see something like that, I tend to pay attention. I do know Jay. I used to meet with him all the time, and he does cover, it is soft line specific. So the other thing that, enters my mind is when we've looked at the apparel spending, specifically in the Bank of America data, it has been weaker than, for example, the electronics and the furniture and some of the other areas. So, and then you got to say, okay, soft lines of the overall 5 or 6 trillion in retail spending, I think it's about $1 trillion, or 1 to 2 trillion off the top of my head. So, I think is this more of the same, or is this a big inflection point? That is one thing that that enters my mind. And then the last thing I would say about this article is, it's just sort of noteworthy how high the uncertainty is right now, because I noticed that in the article, it doesn't look like the NRF, the National Retail Federation, has actually published their estimates for Q4 yet. But I believe it was Accenture thinks they're going to be down 15% year over year, and then Deloitte says they're going to be up 1 to 1.5% year over year. So it's kind of all over the map. And I guess to wrap it up is it's something I'll be paying attention to. I don't necessarily, maybe that will be true of apparel and some of those soft lines, but I'm still sticking with my guns. I think it'll be a pretty good holiday season.
Yeah, I mean, looking back at this Bank of America data here just for a second. So clothing on the latest week that we have. So this is the week ending the 17th of October. We have clothing spending up 2% year over year, but that's compared to, let's say, furniture, which is up 26% year over year, or online electronics, which we have discussed as an outperformer, is up 71%. So yes, it's been a little bit lukewarm compared to some of the other segments here. And I think one of the big things that's going to play into this is the COVID cases. I mean, we keep saying it. We're not out of this pandemic. If you look at the consumer confidence and overlay it with COVID cases, you can see that the peaks and valleys match up. So they work inversely of each other. Where we've seen the lowest consumer confidence is the 2 months we've seen the highest COVID cases, which I think is August and April. Off the top of my head, I think it's August and April, which now we're reaching that new daily high right now in October. So I have to think the preliminary number from the University of Michigan came out for the consumer sentiment, and it did grow a little bit, I think, to 80.2. But I wouldn't surprise me if we see that number fall back a little bit. I think that the media is going to be all over rising COVID cases. I think that this dark winter idea that we keep hearing may come to fruition, and it might scare some people into saving some money through the winter. But all that being said, I'm with you. I still think we have a strong holiday season. I don't think we need that benefit, which I once thought we did need. I don't think we need it, but I'm weary of the COVID-19 cases moving forward.
So that makes sense. And the other thing that the pickup in COVID-19 cases It obviously depresses economic activity because then everybody's got to stay home, and it really limits that sort of snapback, and particularly in services demand for things like hotels, restaurants, leisure, travel, all that sort of thing. So there is a real economic effect, but what it also does is it dings the stock market, and so when people start to see their wealth going down, then that really hits those big ticket items, and there's this waterfall effect. But one thing that I know, following Warren Buffett for a very long time and watching all his annual meetings, one thing Warren will always tell you is, don't bet against America or the American consumer.
American consumer.
And when, following this space for 10 years and just, trying to short stocks, and it's just so hard to do because, the last time, for example, holiday spending, do you know when the last time holiday spending in the U.S. fell?
Ooh, 2008?
2008. And the last time before then?
Ooh, 80s?
It had to have been at least in the 90s because the chart I looked back on went back to 2000. So that's one out of 20 years. So I do think, and then when you think about Christmas, there are so many emotional attachments for a consumer. It's really hard, especially if you have a family. You're just going to cut back somewhere else. In my opinion, and rather than not spend money on Christmas presents. And people have proven, generally that they'll go into debt or they'll tap into their savings to do it. So I really doubt it'll be down much if it's down at all.
Yeah, I mean, you're right. We've proven, the American consumer has proven that if you give us money, we're really good at spending it. I mean, look at the retail spending. I mean, it's got this. You're talking about a V-shaped recovery. Look at retail spending. It fell, I don't know, 20%, 30%, and then within 3 months is back up above 1.9% in the recent month, year over year. So Americans will spend money if you give it to us. So let's talk about money in a different sense here. Let's move on to driver wages. This is our big conversation. We're going to hammer this out for the last 8 or 10 minutes here. Seth, you recently wrote a paper on driver wages, kind of the inflationary cycle that we could be entering based on the hot market and the fact that Schneider National has raised their wages. Give us the premise of the paper. Again, it came on the heels of Schneider National. What are your expectations for driver wages?
Yeah, so I wrote a passport research paper. If you're a subscriber there, take a look at your inbox from last Friday, and we're going to get it posted in Sonar as well. But, the general idea is the trucking market really heated up in March, but really after April, right? And it's just kind of gone vertical. Capacity has really tightened. Rates have skyrocketed. I think spot rates have doubled. And there's just a lot more volume flowing through the system. So when we look at our tender accepted adjusted index, talking about growth of, call it 15% in volumes.
Sure.
And then when you look at the other thing I looked at in the paper, so when you get a short-term mismatch of, you've had the driving, you've got a little bit of a short-term mismatch in terms of drivers. So there's been two main factors weighing on that. So you've got the drug and alcohol clearinghouse stuff, which is crimping the available driver school. You've got all the normal stuff with, drivers going into other industries and being old. But the other thing that is really, and the analyst Jack Atkins from Stevens really went into depth on this last week, which is the average, I think he surveyed, 28 driving schools.
Yep.
And the average driving school today, still, this is 6 months after the major outbreak of COVID in the U.S., and those are still only running at 57% of pre-pandemic capacity.
Correct.
And I think, a quarter of them are still either permanently or somewhat shut down.
22% either permanently or at least in the meantime shut down. I think it said 82 or 88% of all driving schools had been affected at some point, which is just insane.
Right. So when you play that forward, you've got this hot market, you've got booming volumes, new truck orders factor in there as well. Those have been extraordinarily depressed. The last month was just a gangbuster number, but that was the first time in 2 years. And so when you play all that through, you need more drivers. And so what we've seen is, as the cycle heats up and everybody thinks we're going to get a big wage contract rate increase, in 2021, our expectations for at least for a mid-single-digit wage increase. And so, as you get that, you're going to have to pay more of that out to the drivers to both attract and retain them until we can kind of get through this bottleneck. So that's kind of the essence of the paper. But then we went into some other things, like we looked at how much driver pay is inflated over the last decade. And then we went through some of the financial implications of, for example, if this if this becomes widespread throughout the industry, what happens if rates go back down again in 2022?
Yeah, so we won't get into the specifics of that model, but again, it's on freightwaves.com/passport. You get all of our research from Passport, me and Seth's team, as well as JP's team. Go take a look at it. I mean, some incredible stuff there. This driver wages paper is just one of dozens and dozens of paper that comes out all the time, really. So let's talk about this. You think there might be a prisoner's dilemma of sorts here. You think that, or you may think this, you wrote this in the paper. Do you think there is going to be a prisoner's dilemma in which other carriers kind of look at the market and say, if we don't raise rates, we're going to lose our drivers?
I think so, and especially, so one thing we talked about in the paper is, so when the big guys start doing it, everyone else almost has to follow suit. So, John Kingston, one of our writers, wrote a story about how Schneider National, who's a gigantic fleet here in the U.S., they raised their team driver pay by like 7% for experienced drivers. And so that should kick off, because if you think about it, just amongst the big carriers, if you're working for one of the other 4 or 5 and you're not getting that pay increase, you're going to say, hey, I want to go over to Schneider, and then so on down the line. Mm-hmm. And then you've also seen it at some of the smaller and mid-sized fleets. And the other thing that I think we talked about this earlier, but if drivers know that a company is raising rates and their shippers are paying more to move that freight, they're going to want a piece of the action. They're going to deserve a piece of that action. And this is just what happens, right? In traditional trucking market cycles, as it heats up, what ends the cycle is you get, driver pay raises, which attracts more drivers, and then you get more truck orders that eventually, when demand does turn down one day, it eventually swamps it, and the pendulum swings back the other way.
So let's talk about the trucking stocks for a minute, because we think that we may have reached a peak. They may have reached a peak. That's a mouthful. They've traded off about 10 to 15% as a whole, pretty much. We track this weekly in our DHL Supply Chain Pricing Power Index. We have our trucking stock indices there, and we've seen them kind of trade off over the last couple of weeks. Why do you think that's happening? Do you think they haven't seen this the bottlenecks at the driver training schools, or what do you think the reason is that you're seeing a sell-off now?
I think there's a couple things. So the stock market is very forward-looking. So generally, I'd say 6 to 12 months in the future. So right now, people are saying, we know 2020 is great. We know 2021 is probably going to be even better. But what does 2022 look like, right? So I think as people are looking through that, and now it's a little bit of, is this as good as it gets? And if so, I want to get out of there before the selling pressure begins. So in other words, even though the actual trucking market and the economics of that market itself may stay hot for another 9 to 12 months, the stocks may go down before that. And so while most trucking companies may have a banner year in 2021, their stocks may not. So I think it's a little bit of that. And so spot rates, we've seen the truck stop national spot rate per mile. It peaked out around $3?
Yeah, just a hair under.
It's about $2.80 right now. So I think whenever it gets up to $3, generally you start to see a flush of capacity, and you start to see those new truck orders. And we got that in September. So in September, the new truck orders increased by 145%. So I think it's a little bit of investors shooting first and asking questions later, and having sort of an itchy trigger finger. And the other thing that I think that could be playing a part is, if you think about portfolio managers and dedicated transportation investors, there could be a money rotation effect going on. Because to me, as I look at trucking stocks, or early cycle stocks, because they have all that operating leverage to when the cycle inflects higher, some of the other areas, such as rail, where volumes are just now starting to look like they might go positive for the first time in years, LTL, intermodal, stuff like that, on a relative basis, and even brokers and 3PLs may be a more attractive place to start parking your money.
Yeah, I mean, as that, you're right, early cycle. That's what we write. You wrote your recent, actually, it wasn't recent now, the freight performance across the brokerage cycle, which again is another Passport research paper where we talk about how brokerage margins squeeze towards the beginning and expand towards the end of the cycle there. But yeah, so that works on that. So we've got, again, a huge week coming up for us. Next week, we've got a 3-day event. The first day is the Venture Summit. The next 2 days are our FreightWaves Live at Home. We've got some amazing lineup of speakers. Steve Case, the former co-founder of AOL, will be the keynote for that Freight Tech Summit, for the Freight Tech Venture Summit. We've also got the Freight Tech Awards coming up, which I'm very excited about. This is something that I do. Make sure to tune into that for that Thursday morning. But that's all we got. You guys have a great rest of your week. Keep killing it. Thanks for tuning in. Have a great one.